In the last episode, we covered letters of credit, where a bank's undertaking can turn payment into a document compliance question. Documentary collections look similar from a distance because banks are still involved and documents still control the flow of the transaction. But the risk profile is very different. In a collection, the bank helps move and release documents under instructions. It does not make the same independent promise to pay that you would expect under a letter of credit. In this episode, we break down how documentary collections work, the difference between documents against payment and documents against acceptance, where collections can fit, and why exporters need to understand exactly what risk remains after the goods ship. The core point is simple, but it is easy to miss. A documentary collection is a banking process. It is not a bank guarantee. The exporter ships the goods and sends the document package through banking channels. The buyer usually needs those documents to obtain possession of the goods or clear them through customs. The collecting bank follows instructions about when those documents can be released. But if the buyer refuses to pay or cannot pay, the bank is generally not stepping in as the obliger. That is the line exporters have to respect. Banks may control the paperwork, but they are not taking the same payment risk they take under a letter of credit. Here's the basic flow. First, the exporter ships the goods and prepares the invoice, transport document, and other required paperwork. Second, the exporter sends those documents to its own bank with collection instructions. Third, the documents move through the banking channel to the buyer's bank, where they are presented to the buyer. Fourth, the buyer receives the documents only when the release condition is satisfied. That condition may be immediate payment, or it may be acceptance of a time draft or other promise to pay later. The important thing is that the bank is facilitating control over documents. The buyer still drives the payment decision, and the exporter still needs a plan for what happens if that decision goes badly. Two phrases show up constantly in collections: documents against payment and documents against acceptance. Under documents against payment, often shortened to DP, the buyer should receive the documents only after paying. That gives the exporter some leverage because the buyer needs the documents to get the goods, but it still depends on the buyer deciding to pay and being able to pay. Under documents against acceptance, or DA, the buyer receives the documents after accepting a time draft or payment obligation. That may support a sale where credit terms are commercially necessary, but once documents are released, the exporter has effectively extended credit. In both cases, banks are managing documents. They are not providing the same payment undertaking as a confirmed letter of credit. So, where do documentary collections fit? They often sit between open account terms and letters of credit. They may make sense when the buyer relationship is established, when a full letter of credit is not practical, or when the documents create meaningful control over the cargo. They can also be less administratively intense than a letter of credit in some transactions, but that does not mean they are automatically safer, easier, or better. The right structure depends on the buyer's credit strength, the country environment, the goods, the logistics chain, and the exporter's cash flow position. The goal is not to pick the instrument that sounds simplest. The goal is to match the payment tool to the risk that actually needs to be solved. The danger is assuming that document control equals payment security. It does not. A buyer may refuse the documents after the goods have already shipped. Goods can sit at a port while storage charges, delay costs, or deterioration risk build up. In some markets, local practice or legal rules may weaken the exporter's practical control over the cargo. Under DA terms, the buyer may take the documents, obtain the goods, and then pay later, which means the exporter is carrying receivable risk, and collections do not solve country risk, currency controls, political disruption, or a buyer's deteriorating financial condition. Those risks may need separate analysis, not wishful thinking about the bank channel. Before relying on a documentary collection, exporters should pressure test the whole transaction. What happens if the buyer refuses the documents after shipment? Can the goods be redirected, resold, stored, insured, or recovered without destroying the economics of the deal? Do payment terms, document release terms, and logistics realities line up? And does another tool belong somewhere else in the structure, such as trade credit insurance, political risk coverage, MIGA support, or EXIM Bank support? None of those tools is automatically better or easier than the others. The question is, what risk each tool is meant to address? Impello helps clients evaluate that structure and coordinate the right advisory path without replacing banks, counsel, freight partners, or internal credit teams. The takeaway is that documentary collections can be useful when everyone understands the risk. They become dangerous when they are oversold, as if they create the same payment protection as a letter of credit. If your export sale uses a collection, focus less on the label and more on what happens if the buyer does not take up the documents or takes them up and pays later. That is where the real risk lives. In the next episode, we will cover open account terms where exporters ship first and often become the buyer's lender, whether they think of it that way or not. Subscribe so you do not miss it, and leave any trade finance questions you want us to break down next.